Hi, this is Jan Getty from First Guardian Group, and we would like to welcome the Sidway co-owners that were able to attend today's call to discuss 1031 and DST tax strategies. Presenting today is Leonard Spoto, a principal of Asset Exchange Company, and Paul Getty, President and CEO of First Guardian Group. Please feel free to ask any questions along the way. The lines are not muted. You can also email your questions to me. Paul, did you want to introduce Leonard?
Well, you know, we've been working with Leonard. This is Paul Getty with First Guardian Group for quite some time, and Leonard is based in the San Francisco Bay Area, but his practice is national, and Leonard is an exchange accommodator, but more than just a person to kind of do the mechanics of the exchange. Leonard, as you're going to hear during the presentation, is very, very knowledgeable in terms of kind of the general 1031 exchange process, but also is very familiar with some of the details that occasionally crop up where things may get a little bit more complicated. So I think those of you that have contemplated a 1031 exchange, really reach out to Leonard, and I'm sure he would be happy to answer your questions and work with you. And again, no matter where you're located in the country, Leonard and Leonard's team can work with you. His number is on the front slide here. In case those of you that are listening to the recording don't see this slide, the number is 877-471-1031, and Leonard's email address is Leonard, Leonard, at Alpha X-ray 1031.com. Leonard, I'm going to turn it over to you, and then I'll jump back in as we get about halfway through, okay?
All right, Paul, I think the next slide was the disclosure slide. Did you want to talk about that at all?
You know, I'll just touch on it. Let me see if I can get to it. Okay. Hang on for a second. Okay, the slide 2 is kind of our standard disclosure slide. These are securities. They deal with real estate products, and I guess by way of risk disclosure, real estate isn't a guaranteed return. It can go up and can go down. But they are the properties that we're going to be talking about as we get later in the presentation are primarily available through securities dealers. First Guardian Group is a securities dealer. We're also real estate brokers, so you guys can feel free if you've got more questions, any of the things that we cover as we get deeper into the presentation, to give us a call, and we can go over specific offerings and talk about suitability and such. So that's all I want to say on that slide. And we'll move on now to what's labeled slide 1.
All righty. So thanks for having me, guys. And, if you do have questions, as Paul mentioned, just go ahead and chime up. So what we're going to talk about today is Section 1031, which I think is one of the greatest wealth building tools available to investors. And within the tax code, Internal Revenue Code, Section 1031, it basically says, and Paul's got kind of the word-for-word quote there on the screen, but it basically says that if you're selling an investment property, you can defer the capital gains tax on that sale if you go out and exchange into another property. So no gain or loss shall be recognized on the exchange of property held for productive use in trade or business, blah, 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 right? So you can defer your capital gains tax liability if you go out and exchange into another one. Now think about this. You sell a share of Google stock. You make money on it. You pay taxes regardless of what you do. But with real estate, you've got this really great wealth-building tool, Section 1031, which you can use to your advantage to keep all of your money in your pocket and then use it for the next opportunity as long as it's real estate. So a couple things we'll talk about in terms of the qualifying requirements. First of all, when you do an exchange, you have to be exchanging investment or business use property, right? So that's one of the caveats. You have to sell investment or business use property. You have to go out and buy investment or business use property. So 1031 exchange, not for your homes, not for your stock, just for your investment property, and a fantastic way to build wealth by keeping all of your money in your pocket, using it for your next investment. So you guys want to go ahead to the next slide there? Now, why is this so powerful? Well, it's powerful because about 33% of your gain goes to pay taxes if you don't exchange. So Paul's got a nice little breakdown here of the various taxes. So remember, if you're going to sell real estate, you're going to pay taxes on a couple different levels. You pay taxes to the federal government and the state. Now, most states have taxes. We're in California, so we here in California have the highest state tax. Some states like Texas don't have tax, but most do. So when you think about your total tax burden, usually you have to think on two levels, federal and state. Now what I tell my investors is assume about a third of your gain will go to pay taxes. Now that's a good approximate or good kind of blended average. But at the state level, you're going to have 15 or 20, the federal level, you're going to have either a 15 or 20% capital gains tax. You've got an Affordable Care or an Obamacare tax of 3.8%, and then there's a tax on the amount of depreciation that you've taken, which is about 25%. So those are the federal taxes, and then if you're looking at the slide, Paul's got the state tax there in purple, which can be up to, here in California, as high as 13.3%. So obviously, if you decide to sell an investment property, you can sit down and crunch the numbers with your CPA to get the exact dollar that you could potentially owe. But a good rule of thumb, again, is assume about 33, maybe a little bit more, 33 to 35% will go to pay taxes. So let's jump to the next slide. So here is just a simple kind of illustration of how the 1031 exchange can increase your wealth over time. Imagine you pay taxes. Well, you're going to be on that bottom curve, right? You're going to build wealth a lot slower than if you could not pay taxes. You have the opportunity to keep that 1/3 that would have gone to the government in your pocket and use it to leverage into bigger and better deals. So I always joke I've got 3 partners in life. I've got my wife, and I've got the government and myself. So there's 3 of us on every deal. Well, imagine if we could take that third partner out. The government doesn't have to get its share. Well, we can do a lot better, my wife and I, investing in real estate. We're going to be on that top curve there, the 1031 exchange curve, no taxes paid, and we're going to see a dramatic acceleration of our wealth building. If you have less money to invest, you're not going to do as well. But keep that money in your pocket, you've got more to leverage into, and you're going to do a lot better. So next slide.
Before we move on, Leonard, there's a comment on the bottom I want you to maybe elaborate on, the swap till you drop and the notion of what happens to your wealth building if you pass or when you pass.
Yeah, absolutely. So the great thing about taxes and 1031 exchanges is that you're deferring those taxes. So that's fantastic. You don't have to pay them today. But the problem with deferring is you're not getting out of taxes altogether. If you do cash out, you have to pay the piper. Okay, everybody's going to pay taxes at some point, right? So if you cash out, you're going to pay your taxes. Now, the good thing about some of what are the strategies out there for some of the exchangers that we work with is that if you don't cash out, well, guess what? You don't pay taxes. So a lot of the investors in my office that we work with, they plan on doing what we call the 3 Ds, deferring, and dying, or what Paul has illustrated here, swap till you drop. You just keep swapping your properties until you drop, you pass away. Now, most of you may know this, but when you pass away, your heirs, your children most likely, will inherit your property. But the great thing about inheriting property is that the basis in the property steps up to fair market value. So if you have a basis in a property that's very, very low and your fair market value is very high, you've got a lot of gain. But when you pass away, that basis, which is very low, is going to step up to fair market value. All right? And your heirs, your kids, could sell the property the day after your funeral and pay 0 in capital gains taxes. So your capital gain tax would have been huge had you sold, but you didn't sell. You own that property until you passed away, and your heirs are going to benefit from that step up in basis. So really proper planning with our real estate investments through the 1031 exchange is going to allow us to defer taxes, and then proper planning when we pass away is going to allow our wealth to be passed on, all of our wealth to be passed on to our future generations without that capital gains tax burden. So there's tremendous benefits here.
Leonard, Paul, again, does that also apply to depreciation recapture, or is it just capital gains?
Yep, it applies to both. So you get that basis step up completely.
Okay.
And state tax.
All right, you guys want to go to the next slide?
Yeah.
So we touched a little bit on this. The slide is, what is like-kind? So if you actually read the tax code, it says you have to exchange into like-kind investments. Now, this can be a source of confusion for a lot of our investors. I've had people ask me, well, geez, Leonard, if I sell a 2-unit building, do I have to buy another 2-unit building? And the answer to that is unequivocally no. If you sell an investment property, you have the flexibility to buy any other type of investment or business use property. And we've got some listed on the screen there, so you can trade into and out of single-family rental homes, vacation rentals, apartment complexes, rented condos, commercial properties. You can get into the DSTs, which Paul's going to talk about, where you own a slice of a very large institutional grade property. As long as you are holding those properties for business or investment purposes, they are going to qualify for the 1031 exchange. So you have a lot of flexibility in what you exchange in and out of. Now, a couple caveats. You cannot leave the country. So if you sell in the United States, you cannot buy in Mexico or Canada or China. You've got to buy, reinvest in the United States. The other thing that you want to keep in mind is inventory cannot be exchanged. All right, so there are certain circumstances where real estate is considered inventory. I'll give you 2 examples. Number 1, a quick flip, or number 2, a development deal. All right, most of you are probably not developers and quick flippers, but if you are paying taxes. But if you're a regular investor, you hold those properties, you rent those properties out, you exchange them, you've got a lot of options. All right, next slide, guys.
Okay, we're moving to slide 5.
Yep, slide 5. All right, so slide 5 details the second requirement of a successful exchange. So the first requirement is what kind of properties qualify. Make sure your properties are investment or business use properties. Second requirement for doing your exchange is get it done on time. So when you do your 1031 exchange, you've got some time frames to adhere to. So unfortunately, the government, when doing an exchange, only gives us 180 days to complete it. So your time frame is going to start on day 0, right? That's the day you close escrow. You then have a total of 180 calendar days to go out and purchase your replacement property. So 6 months, 180 days, that's plenty of time, right? Well, unfortunately, within that time frame, you have to identify what you're thinking about buying on day 45. So day 45 is very, very important. You're going to actually have to submit in writing a list of the possible properties you're considering exchanging. And once you've submitted that list on day 45, you are locked into that list, right? No changing the list, no making additions or substitutions after day 45. So one of the things, especially in this market, that is crucial, there's not a lot of inventory out there. So our investors, when they're doing their exchanges, you're going to close escrow, and you should be aggressively looking for replacement property. Because number 1, there's not a lot of inventory, right, to choose from. Number 2, those 45 days are going to go quickly. If you can't buy something from your nominated identification list, after day 45, you can't change it, so you could potentially fail your exchange if you can't buy anything from that list. And one of the great things about DSTs, which Paul's going to talk about, is they're a lot easier to get in, too. So you have a little bit more inventory in this market. You've got, I don't want to say guaranteed access, but you know, it's a lot easier, I think, as Paul will demonstrate, to get into a DST than maybe an apartment building right now. There's just so much money chasing these limited apartment buildings for sale. They're very hard to exchange into. And you might be overpaying if you do get them. So I think the DST are gaining popularity for that factor and a lot of other reasons that Paul will get into.
Leonard, one of the questions that does come up on this slide, I'm going to cover it, is some accommodators, at least some of our clients believe that some accommodators will frankly allow them to fudge the date. So it's actually day 46, 47, they'll backdate documents, and I want you to kind of comment on that, because I know that practice went on, you know, back in the old days, but the times have changed. Can you comment on that a little bit?
Yeah, let me tell you the problem with that. It's tax fraud. So I think, the people who were doing that were taking a pretty aggressive approach and risking, their careers in the industry. It did go on, though. It was pretty rampant, back in the day when we had paper files because the IRS, they audit your paper file. Well, you take the old paper out, you crumple it up, you shred it, and you put a new piece of paper in. So things have changed since then. Number one, everything's electronic, everything's time-stamped, so that's one thing that makes it tougher to cheat. The other thing is that the Franchise Tax Board, at least here in California, they have gotten very aggressive on their audits of 1031 exchanges. So in 2012, they made audits of exchanges one of their top priorities. And what they did, guys, is they didn't just go after individual exchangers. They started auditing exchange accommodators. So in 2012, my company got audited, as well as every major national accommodator operating out of California that we know of. So there's probably some small guys that, didn't get audited, but if you're a bigger, more reputable national firm doing, delayed reverse construction exchanges, you got audited in 2012. So, I think that the stakes got a lot higher for everybody because of the aggressive approach of the FTB here in California. So I wouldn't recommend it, and I wouldn't recommend working with an accommodator that is letting you cheat because they're letting other people cheat too, and their whole business could go down the drain if the FTB audits them. And you don't want to be involved with them during their audit if they go down the drain. So be very careful.
Okay, let's move on. Slide 6.
All right, so in this slide, what we're talking about is what you have to do to complete a 100% tax-deferred exchange. So there's a couple things you have to do. When you sell a property, you have to purchase equal or greater in value. All right? So if you sell a property, what we look at is your net sales price. So let's assume you're in contract to sell a building for $1 million. You're going to pay $100,000 in commissions and closing costs. So your net sales price would be $900,000. You need to go out and purchase property equal or greater to that $900,000 net sale price. And the way you do that is you have to use all of your cash, your sale proceeds, and take on equal or greater debt. Or if you don't take on equal or greater debt, you're going to have to contribute additional cash out of pocket. So what I always tell people is go out and buy property equal or greater in value and make sure you reinvest all of your cash. All right? We're going to talk about the situation where you don't do that and how it could come into play and what the results of not buying equal or greater in value would be. But think about it this way. Anytime you go down in value, you're going to pay taxes. And we have a couple slides that illustrate some examples here. So you want to go to slide 7, Paul?
You got it.
All right. So here we have an example of a property that was sold for $200,000. All right. Escrow expenses were $10,000. So what we're saying is that escrow and commission and all of our closing costs were $10,000. So we then also pay off our debt of $100,000. That gives us cash that comes to the exchange accommodator. That's me. Comes to the exchange accommodator of $90,000. Remember, when you do an exchange, you can't touch your money. It's kind of like a 401k, right? There's rules on how you access those funds and have to work with a custodian. Well, in the 1031 exchange world, we are that custodian. So in the 1031 exchange world, much like the 401k world, you can't touch or control those funds. So your $90,000 are going to come over to the exchange accommodator. Now, you tell me you want to go out and buy a property. So what you're going to do is use the $90,000 to buy a new property, but you get, in this case, new debt of only $100,000. So you add your $90,000 of equity to your $100,000 of debt that you just took on, and what you did was you bought a property for $190,000. Boom, you're done. This is a good exchange, an even exchange. You pay no taxes. So example number 2, Paul. All right, here's a situation that results in a potential tax liability. So let's look at the same set of circumstances. We sold our property for $200. We had closing costs of $10. We had $90,000 come over to the exchange account. But this time what we did was we bought a property for $180. Right? We reinvested all of our cash, which is the first thing we need to do, but we only took on $90,000 of debt. So that difference in my world is called debt relief, and that amount is taxable, right? Think about it this way. You went down in value. Whenever you go down in value, you pay taxes. Here we just didn't take on enough debt. We didn't buy enough real estate. We're paying taxes on that $10,000 difference. All right, next slide. All righty, same set of circumstances, all right? You sold for $200. You had $190,000 net sales price. $90,000 came over to us. You say, well, geez, I want to go out and buy a $190,000 property. I'm going to go ahead and use my 90. I'm going to get debt of 90, but this I'm going to contribute cash. Well, that's fine. You took on less debt, but you offset the debt relief with cash out of pocket. So whenever we're doing exchanges, cash is king, ladies and gentlemen. Some people think, well, I absolutely have to replace my debt in an exchange, and that is not necessarily true, because you can always contribute cash out of pocket to offset any debt relief. You don't take on as much debt because you want a lower mortgage, that's fine, as long as you come out of pocket so that you're still buying enough real estate. Here we sold for $190 net and we bought for $190. We have an even exchange. We pay no taxes. All right? A lot of people think, well, geez, all I have to do in an exchange is reinvest my cash. No, that's not true. Some people think, well, geez, all I have to do is reinvest my profit. No, that's not true. To defer all of your taxes, reinvest all of the cash, and purchase property equal or greater in value. All right, next slide, guys. All right, this is a situation where we have some cash boot. So same set of circumstances, but this time we wanted to get some cash and put it in our pocket. All right, so we didn't use all $90,000 that we had in the accommodator account. We only used $80,000. We didn't spend all the cash. So that $10,000, if not reinvested into a second property, is going to be taxable. If you take cash out, you don't reinvest all of it. If it goes to you, that cash is taxable. Now remember what we talked about several slides ago. About 33% is a good blended average of the tax rate you'll pay. So you can easily do the math here and say, well, geez, if I take $10,000 out, about $3,000 is going to be my tax bill. And that's fine. You can do partial exchanges. You don't necessarily have to defer all of your taxes. If you go down in value, you may want to do that. And if you do, you simply have to be prepared for a tax liability. All right, next slide, guys.
Before we move on, are there any questions from anyone on the call? I guess not. Leonard, why don't you go ahead? Oh, Mark, did you have questions?
No.
Okay.
Okay, Leonard, we're on 11.
All right, guys. So slide 11 is going to talk about vesting. And vesting is important when you are doing 1031 exchanges because the IRS has what we call or refer to as a same taxpayer requirement, meaning that the taxpayer who is selling property needs to be the same taxpayer to buy replacement property. Now, normally this doesn't really cause too much problem, right? You might own a property with your wife, you sell it, you buy a new one with your wife, you guys own it, no issues. But if you're going to buy a property in an entity, like an LLC, if that LLC has more than one member, or if the LLC contains multiple unrelated parties like you and your friend, there are situations where an entity, such as an LLC or a partnership, could have its own taxpayer ID number. right? So if the LLC is a multi-member LLC, it's assigned its own taxpayer ID number. And if a property is owned by that LLC and you want to exchange it, well, the LLC has to do the exchange. So we are always very aware how our clients are taking title to their property because it needs to match how they sold. The taxpayers need to match. So when you are doing exchanges, you always need to make sure that the taxpayer who sold is the same taxpayer who's buying. Now, normally this doesn't cause a problem because people, like I said, are usually selling on their own or buying on their own. And you might want to put your property in a trust, and that's fine because a trust is disregarded for tax purposes. It's not assigned its own taxpayer ID number. An LLC is fine as long as it's disregarded, and again, an LLC could potentially be disregarded if it's just one member or a husband and wife that are the sole member of the LLC. So the vesting is always an issue. When you work with a company like mine, we're going to make sure that the vesting requirements and the same taxpayer requirements are met. And that's one of the things that we have kind of on our radar screen to always look at is the vesting matching, and are you taking title in the way that you're supposed to be?
Leonard, a question came in. I think it's a two-parter. What happens in a situation where a husband and wife own a property and one or the other passes, leaving the other one, in some state of ownership as they contemplate a 1031? And related, kind of part B on that, what if it's not a husband and wife? What if it's just two partners, that have gotten together and have bought a property, and one of them passes and the other one remains owning the property? How does that impact the ability to do a 1031 exchange?
Yeah, so, it depends on how they hold title, right? So how you hold title is important. For a husband and wife, you can hold title, as tenant in common. You can hold title as joint tenants. You can hold title in a lot of states as community property. So a husband or wife passing, one spouse, usually doesn't cause any type of problem, right? And the property either will have a stepped-up basis or a partial stepped-up basis, or if the property isn't sold the same year that the spouse passes, maybe there's some additional built-up gain. So we see, a spouse passing all the time, and those situations usually don't present any problems. So the surviving spouse doesn't exchange, defers gain, and doesn't pay any taxes. Where it gets a little trickier is if you have a business partner that passes. Again, depending on how the property is vested, that could cause a problem. So joint tenant ownership, maybe you're set up as a joint tenant, and what would happen is you would inherit that person's share of the property at a stepped-up basis. If it's not a joint tenant, if it's a tenant in common ownership with two partners and one partner passes, that deceased partner's heirs will receive the property. They may or may not want to exchange, and in a tenant in common ownership structure, they can decide to pay taxes, and the other person can exchange. If the ownership is in an LLC with a business partner, then it gets a lot more complicated, right? Because an LLC member passes, the heirs will receive the LLC shares, and now they're an owner of the LLC. And if they don't have the same plans as you, things could get tricky. And you might have to dissolve that LLC and drop down into a different form of ownership. So again, we're here to advise on some of those more complex issues, but most of the time, it's not a problem.
When a husband or wife passes, you mentioned the step-up, is that portion, let's suppose husband and wife own 50-50, so 50% of the property passes to the remaining spouse. So that tax liability then is stepped up and is dissolved at that point?
Yeah, so you're going to have a step up in basis. Exactly. And to be honest with you, I don't know if it's a step up in basis on just the 50% or the 100%, but that's something we can look into. And I believe it depends on how the vesting is held as well.
Great. Okay, we're moving to slide 12.
All right. Did you want to take over here, or did you want me to mention some of these options here?
We'll cover a couple of them, and then I'll jump in on three and take it for the remaining three slides.
Okay, perfect. So, we deal with thousands of exchanges here in my office every year, and typically we see people when they're coming out of a property or a TIC or a DST, you've got a couple different options. So, number one, you're just done, right? You say, I just cash out, I'm going to pay my taxes. Again, we mentioned the effective kind of average tax rate of about 33%, so prepare for that. You'd be surprised that people say to me, well, Leonard, I'm going to pay taxes because they're only 15%. Well, that's just one component of the tax, right? That's just the lower of the federal capital gains tax, which for most people actually won't be applicable anyway because they'll be bumped up to the 20%. But remember, we also have depreciation recapture, we have the Medicare Obama tax, and then we have state. So cashing out and paying taxes, I don't think is a great option unless you're willing to give a third of your gains to the government. Sometimes that makes sense, though, and people do it. Number two is you roll over into another property that you might completely own, right? So you have to find the property. You've got to make sure you can get equal or greater in value, and then you might have to manage that property. For some people, obviously, that's what they want to do. That makes sense. But what we see with some of our clients who are looking to simplify their lives, managing properties when you're retired, a lot of times you want to spend more time with your grandkids, less time with your tenants. So you're looking at option number 3, which Paul's going to get into, which is the Delaware Statutory Trust, management-free kind of passive investments. And Paul and I were talking about this before the presentation started. We're seeing an increasing number of our clients looking to the DST as a replacement property alternative because, number one, there's a lot more good properties that are being structured as DSTs. There's also an increase in the opportunity to get into those properties. So, Paul, you want to go ahead and take it over from here?
One last question. I know you've got another call that you got to jump on, Leonard, and hopefully we won't go too deep into this, but what are some of the other offsets that could come into play as folks are contemplating a tax liability on the sale of their tenant and common interest, i.e., are there other, losses or gains in other areas of their portfolio that could mitigate the tax liability of selling property?
Yeah, so, and you'd want to figure that out, obviously, because if you have an offsetting loss for a gain, then you might not need to do an exchange. So the general rule of thumb is that capital losses can offset capital gains, right? So people sometimes get confused with operating losses. Those are not applicable to capital gains, and those are not offsetting. So the general rule of thumb is if you have a capital loss, you can use that loss to offset your capital gain. So it's always a good idea if you had some kind of sale that resulted in a loss, sit down with your CPA and say, okay, is this going to be applicable for when I sell my building to offset some of the gain? And the offsetting rules can get complicated, and they go into the future where you can carry losses forward for a period of time. So it's always a good idea to get your whole picture on your losses and how they can be used before you decide if you need to do an exchange or not.
Thanks, Leonard. Are there any questions for Leonard? I know he does have to drop off.
Just one quick question.
Yes, Mark.
Yeah, I'm just wondering, Leonard, if you know on the capital loss, does that also offset the depreciation recapture, or is it just a capital gain? I don't even know if that makes sense, but I don't know.
So you've got kind of two different types of taxes there. You've got the appreciation that's going to be taxed at the capital gain rate, and then you have the depreciation that's taxed at the higher rate. So if I have a loss, can I use that loss to offset the whole thing? I believe that's true, but I'm not certain, so I'd need to look that up or talk to our tax attorney about it.
Okay, thank you.
Any other questions for Leonard?
Okay, Leonard, well, thanks a lot for joining us, and then I'm going to continue on with the presentation. You're welcome to stay on, Leonard, but if you need to drop off for your other conference call, you can do that at this time.
Yeah, and hey, guys, I appreciate you having me on. So I'm available. I think Paul gave everyone my phone number. at the beginning of the presentation. You can also shoot me a quick email if you have follow-up questions or you want to discuss your personal situation in a little bit more detail. And I know you guys have a disposition coming up, so if you do need to set up an exchange account, we'd love to be the accommodator to help out, and we'll do a very good job for you. Appreciate the opportunity to talk with you guys.
Thanks, Leonard.
All right, take care.
So this is Paul Getty. We're going to shift to slide 13 and talk a little bit about the Delaware Statutory Trust. I want to just maybe start with a couple of general comments. Those of you that have been involved in TIC investments, you know, many of you have had kind of bad experience with tenant and common investments, and I know that some of the folks that we talk to really, frankly, do not want to get into another investment where there are other people that are in it. But when they look at the tax implications, Leonard, I think, did a really good job of outlining that, and look at the opportunity from an estate planning standpoint of allowing their heirs to basically inherit a greater chunk of their estate. The 1031 option starts to come up, and then particularly with our investors that are more passive or maybe seeking retirement or nearing retirement, they then kind of struggle with finding replacement properties. Also, with the replacement property, there often is a requirement to go out and get a loan. We've had situations where people, because they're retired and their income doesn't qualify for a loan, that option of getting a wholly owned property is really not a viable option. So now we start to look at other alternatives. I think, as all of you know, that the tenant in common structure is basically not viewed by lenders to be something that they generally want to do. We've seen a couple of exceptions to that in the last year, but generally speaking, tenant in common in terms of a new option is really off the table. And what replaced it in 2004 is what we're going to talk about in the next three slides. It's the Delaware Statutory Trust. The Delaware Statutory Trust, to put it simply, is a streamlined, more efficient version of a way of getting into owning a property with other folks, where the responsibilities are much more on the back of the manager, or since it's a trust, the manager in this structure is called a trustee. One of the biggest responsibilities that they have, they become the sole borrower. They take on all the loan responsibility. They qualify solely for the loan. And as a result, unlike your tenant in common experience, if you may remember, each of you had to qualify for the loan. Under the Delaware Statutory Trust, there's no requirement to submit any financial paperwork or income tax returns or sign any loan guarantees or loan documents. The trustee is the sole borrower. So that's the first huge standout that is a distinct and significant improvement over the tenant in common. Also, there, as a result of not having any loan responsibility, there's no what they call carve-outs. You know, with the tenant in common, there's generally a non-recourse loan, but if you read the fine print, there's a number of things that unfortunately can happen where the loan, even though it's characterized as non-recourse, can come back as a significant liability. And we've seen, unfortunately, a couple instances of that over the last, dozen or so years that we've been in this business. Finally, there is a much reduced cost savings in the structure because there's no requirement for any of the individual investors to form these special LLCs and pay what can amount to $900 or $1,000 a year in paperwork that needs to be filed in Delaware and other states where the property is located, and just the sheer cost year to year is dramatically less under the Delaware Statutory Trust. Back in the TIC era, it was at a point, I think in 2005 or 2006, when there were well over 100 sponsors that were getting involved in the tenant and common area, and frankly, many of those sponsors have gone out of business, and a lot of them shouldn't have been in business in the first place. What remains now, and we're going to cover it on the last slide here coming up, there are a handful of pretty well-capitalized companies led by a company called Inland and then Pasco and a number of others that have very strong balance sheets that have actually performed very, very well for their investors over the last 15, 20 years. And these are the core people that are the only ones that are able to offer DSTs today, because in order to offer a DST, you have to be pretty well qualified and capitalized to qualify for the loan. So I think that makes it, I think, a better structure. I think the last point that I want to make on this one is the minimums to get into the Delaware Statutory Trust because you can have up as many as 500 people investing in any particular property. Actually, there's some exceptions to that where you can have more than that. The minimums drop down to about $25,000. So as a lot of financial advisors will suggest, when you put a portfolio together, diversification is something you should consider. We have a lot of our clients that when they sell a property get into more than one of these Delaware Statutory Trusts, maybe a different asset type or a different location in the country, and that provides some diversification. So the lower minimums here, I think, are also very appealing. And it allows you to mix and match. If you want to take some cash out and defer taxes on a portion, you can do that. If you want to buy a wholly owned piece of real estate, maybe a single-family home, which a lot of our folks do, or a duplex, or even a larger property, you can do that. And with any funds remaining, you can allocate that into the Delaware Statutory Trust as an option. I'm now moving over to slide 14. This slide is entitled Restrictions, but they're actually, I think, should be looked upon as benefits. When a Delaware Statutory Trust is put together by a sponsor, they are required to put all the money into that Delaware Statutory Trust in such a way that there can be no capital call and no additional need for capital anytime during the ownership period. And that's a real key. It's a restriction on the part of people that are putting these things together, but it's a benefit for the investors because there is almost for sure not a requirement of a capital call in the DST. There's a couple of extreme exceptions where if the property really performs horribly, there is an opportunity in the structure to kind of get out of the DST structure and put additional capital into it. But for the most part, these things are fully capitalized up front and much more secure because there's plenty of reserves to do what needs to be done. The second point is that all the cash that comes out of the property has to be given back to the investors every year. The sponsor or the manager can't retain that, so it's kind of like a REIT in that sense. The cash that comes in that's available is distributed on a current basis. The third point here is the trustee generally cannot enter into new leases or negotiate current leases. A slight variation of that is that the trustee could also form what is called a master lease where they become the single tenant, let's say on a, what would be a good example of that? If you were investing in a apartment house, the sponsor in an apartment house, which obviously has a lot of leases that are changing, on a frequent basis, they would form a master lease relationship with the investors where they would, as far as the investor is concerned, be responsible for the full single rent payment. And then they could sublease the apartment as frequently as they cared to under the master lease to other subtenants that would be obviously occupying separate units in there. But to the investor, that master tenant would be the one that would be fully responsible for the full rent regardless of the occupancy. And that's how those multifamily properties are managed under a master lease structure. The only types of expenditures that are allowed are normal maintenance and repair, and those that may be required by law, maybe like a ADA requirement, putting in a ramp for disabled people or something like that. So I think in sum, a lot of folks view this DST to be really a much more efficient, modernized structure that, unlike the TIC structure, puts a lot more responsibility on the part of the manager. They've got to have a much better balance sheet. They can't, do capital calls on the investors. They take all the loan responsibilities. So there's a lot more skin in the game by the sponsor manager than there is in the tenant in common. I will say that what's perceived to be one of the downsides is that the trustee has the full power to manage the property. So in a tenant in common structure, you know that every year you have the right to kick out the manager, you have the right to make certain votes on leases and things like that. And those rights, which sometimes can be abused, are really now 100% the responsibility of the manager. And I guess the analogy that some investors make, it's kind of like buying a share of a mutual fund or buying a stock in a company where you're buying a stock and you're basically trusting the manager to make all the decisions on it. But if you buy a share of Apple stock, let's say, you can't, tell Apple what to do. You basically ride it out, and if the management does the right thing, the stock goes up, you're going to feel good about it. And the DSTs are like that. You're basically giving the responsibility of the management of the investment to the manager, and obviously you should look to pick good managers to do work, and that's another big distinction. You can't have a situation where one investor can thwart the will of the other investors, as an example, and a lot of folks that have been in TICs where that's happened view that structure, this structure, to be actually better than the TIC structure. Last couple of slides. Currently, we maintain an inventory. Dinesh, about how many do we have currently in inventory?
25.
So we have about 25 different programs. I'm not going to go into any detail on this. You guys can look at this offline, but the returns on the DSTs range from probably a low about 4.5% to as high as 7 or 8%, and the income that comes in can be sheltered because you get flow-through depreciation, and depending on the structure of that and your taxes, you end up keeping a pretty large percentage of that monthly dividend that comes in, unlike money that would be coming in from, a stock dividend or other things where you can't write off depreciation. So the net income is quite high in these properties because of that write-off that you do not get from other income, bonds and other things that you may want to invest in. I would say also, too, that the properties that are in the DSTs range from, corporate headquarters. They range from, CVS drugstores, Walgreens drugstores, so single-tenant, triple-net. And there are a growing number of apartments that are done under the master lease structure that I talked about earlier. I know when we've taken polls of our clients, the majority of our clients have made their money in multifamily. Or in residential. A lot of them, over the years have invested in single-family homes and so on, so they have a little bit more of an understanding and an affinity for multifamily, and we do have a few of those. They tend to go about very, very quickly. The most popular ones that we're selling are the multifamily DSTs, followed by the single-tenant triple nets, so like the Walgreens. I think it's on this first page. There's a multifamily in Florida and New York, which I think just sold out this week. And then there's a Walgreens portfolio down towards the bottom of the list. So that gives you kind of a sense of it. If you have interest in wanting to know any more about these, and again, I'm not going to go into any detail here, but we can certainly offline send you brochures and information and actually put you in touch with the sponsors if you want to have a conference call. But we have a lot more detail on any of these. They last, in terms of availability, between 4 and 6 weeks. They tend to come and go pretty quickly. So if you are interested in identifying some of these as part of your exchange, it's good to kind of, try and follow up with us sooner rather than later, because the inventory is changing all the time. I'm going to jump to the last page. As I mentioned, back in the heyday of the fractional interest back in 05-06, there were, probably about 100, 105 sponsors. We now have about 12. And the granddaddy of them all is Inland. Inland currently has about 55% market share in the DST area. Their returns on average have been about 130% if you look at their entire portfolio, and that includes history going back through the real estate recession, depression that we had in 2008. Pasco has a similar track record. Pasco actually focuses exclusively in multifamily, where Inland will get involved in most other assets, including multifamily. That's also true of Capital Square. Four Springs tends to specialize in retail. They have a lot of CVS and Walgreens. Cottonwood does residential. Exchange rate is kind of across the board, and there's several that I didn't list up here that I would add to this list, but these 7 out of the 12 are the ones that have really stood the test of due diligence by a lot of investors. And frankly, these companies have done really well historically. So we highly recommend the quality of the management under any of these companies. And I think if you look at their historical track records, you'd feel pretty comfortable that the money that would be invested has really been returned, and the returns have been everything that's been advertised and more. Are there any questions that any of you have on any of the material that we've covered?
Yeah. Let me ask here. How long typically is the financing on these properties? Is it like 10 years like we have?
Yeah, that's a great question. So these loans are almost always a 10-year loan, but here's what's real interesting about it. They are all assumable that we've seen in our inventory, and some of the programs are designed to basically exit in as little as 3 or 4 years. Many of them exit in 8 or 9 years just before the loan comes due, but here's the kind of interesting thing about it. The loans that we are seeing on these properties are generally in the 4 to 4.5% range. Some of them are actually below 4%. And so the thought process here is that buying property right now with a 4% underlying loan that can be assumed provides a lot of flexibility in a period where interest rates are rising, because the properties that are here, given that you have a lower cost loan that is fixed, these are not variable loans, they're fixed loans. So it's like if it's a 4% loan, it remains 4% for 10 years. So let's suppose we move the timeline 5 years forward and the average interest rates are now, let's say, 6%. You're going to have a lot more interested investors wanting to assume this property, which is easy to do. It's typically a 1% assumption fee, and the value of the property may increase just because of the underlying loan being a 4% loan in a 6% market. So, but I would say the average hold is going to be 8 or 9 years.
Yeah, okay, and it has this projected cash flow. So that would be just on the equity portion of the investment?
Yeah, that's correct. And I would say almost all of these have built-in increases that occur annually. Some of them are every 5 years, but I didn't mention it. The increases are Dinesh, I know you've looked at these. What are the average increases that we're seeing on these per year?
Well, okay, generally increases are like 0.5 point per year. But what happens is many times these properties have 3 or 4 years of interest-only loan initially, and then they start amortizing. So although you are actually earning a lot of money, but some of that goes into paying the debt service. So your cash flow sometimes does not go up as much in terms of distribution to you, but the actual income is increasing.
Yeah, and your equity is increasing.
Equity is increasing, so the loan amount is decreasing. So that is also building more equity. So generally, they're all going up like 0.5% to 1% per year, depending on the situation. And it comes mainly from the rental increases. So multifamily, because of the inflation, rents are going up. And otherwise, if you're a single tenant, there is a fixed rent increase of 1 or 2% per year. So those are the reasons why the income goes up.
Yeah, sure. And another question is on the Sidway deal. I haven't calculated out what the proportion of the sale would be returned to us. And I'm looking at this leverage.
Randy,
yeah.
This is Jan Getty. I have that breakdown, and I will forward it along with the recording.
Okay, but it just looks to me like we would have to come up with some out-of-pocket cash to get into these deals from the Sidway, correct?
Well, it depends. You're raising a really good point, and I want to just elaborate on your question. It's an excellent one. You want to tend to match, as Leonard was saying, the cash and the equity. You can offset debt with more cash, but typically the DSTs have a pretty broad range of what's called LTV, loan to value, and that's the ratio between the amount of equity that you'd be getting out in Sidway and the amount of debt that would be getting out. And the range in the DSTs is probably below about a 50% LTV. So some of them have no debt. So, there is a broad range. I'd say the average is running about, 55 to 65%, kind of in that range. And depending on the numbers that Jan's going to forward you, does Sidway fall in that range, Jan, just generally? Do you know what the debt to equity? So that is something to take a look at, but I will tell you, when you go through that calculation and you look at potentially a 33 or 35% tax bite, depending on where you might be, the numbers still net work out to be pretty favorable, and we can offline go through that with you, or your accommodator can do that with you, and you can make a decision. It's still a pretty significant savings, even if some of it has to go to pay taxes.
The good news about DST is that your investment amount is not as large, so you can still make investment and majority of your taxable income, even if you have to pay tax on some small amounts.
Yeah. And honestly, we have a lot of investors that are not doing exchanges that go into DSTs all cash simply because when they view the stock market and they look at other bonds and CDs and everything else, and they see now that they can get 6%, that is tax sheltered, where a lot of that 6% stays in their pocket. It turns out to be a much better deal relative to other things that may be perceived to have more risk associated with them that still are going to provide, pretty good retirement income at 5-6% or greater.
So do you guys manage any of these properties?
No, we do not. We basically don't have an interest in any of the DSTs, from a standpoint of recommending anything. We basically are intermediaries to help people qualify to get in these and understand what they want to do. The folks that are listed here on slide 18 are, frankly, really, really good managers. So we currently are not managing it. We've been asked to do that, but we're not doing it currently.
And you said that Pasco is just doing apartments now?
Yeah, they have shifted into multifamily because I will tell you a lot of the investors, certainly that we have, are very comfortable with multifamily. The big advantage is that you can raise rents faster. The single tenant triple nets are kind of, whatever the deal is, and it's like a 15-year lease. So multifamily is really done, generally speaking, very well, and Pasco's decided to specialize in that because they're hard to find, and frankly, they're tougher to manage because you have to capitalize the multifamily up front. That means it's typically a newer multifamily because you can't put a new roof or a new driveway in it, and you can't do a lot of major repairs on it. So it's got to be a newer multifamily, and those are even more difficult to find. But they focus on it, and they do a good job.
The biggest benefit of multifamily over single tenant triple net is the leases.
Shopping centers?
The shopping centers are also very popular, but I would say that retail as an asset class is not as popular as corporate or as multifamily. And there's exceptions to that. The big exception would be the banks. I guess it's kind of semi-retail, but the pharmacies and drugstores, so Walgreens and CVS are highly desirable. The challenge is that they're so desirable that they've been bid up to a rate where the returns can be in the 4 to 5% range. So the drugstores and those types, which are fantastic investments, unfortunately have so much demand that the prices are bid up and the returns are less. And also the rent bumps are not as great. A Walgreens has a rent bump once every 5 years as an example. Typically, there's exceptions to that. So any other questions before we wrap up? I think we wanted to keep this under an hour. We're approaching on the hour right now.
I have a question. You said the average hold period is 8 to 9 years, and so is this similar to a TIC in that it's difficult to get out?
It is today. These DSTs have been around since 2004, and they are really increasing in popularity, and there is talk. Actually, I'm going to be at a conference next Monday and Tuesday in San Diego where there is going to be a panel discussing trading shares of these. And in theory, that could happen. There's no real restriction on it. But I think right now, today, the short answer is you should look at these as basically restricted interest with little market, and you should look to hold on to these for the long term. That may change as more people get into these, but today they are not considered liquid investments. It's not like buying a share of stock today that you can sell tomorrow.
Right. And the returns they show, especially on things like a Walgreens, is that basically guaranteed because they have a lease for X amount of years, and that's the rate of return it's going to be?
Yeah, it's as guaranteed as the lease would be, if Walgreens stays in business, and we all hope that they will. But, I know that our securities for dealers, they never want us to use the word guarantee, but they come pretty close to it because they've never really defaulted on any of their lease obligations. That's why their credit rating is so high. So if you stick with what's called credit tenants. One of the reasons a credit tenant is a credit tenant is that they have a history of honoring their obligations. And that's what these tenants are. They're largely credit tenants.
Are there any other questions?
I just wonder if you ever heard of anything called a UPREIT. You can exchange into UPREIT.
Well, yeah, but the challenge with the UPREIT is you can exchange into an UPREIT and not have to pay taxes at the time you invest in the UPREIT. But when you sell that UPREIT, you've lost your 1031 exchange. You basically have to pay tax, 100% tax, recapture depreciation, and capital gains when you come out of the REIT. A REIT is not a 1031 structure. You can go into it through an UPREIT, but you can't come out of it. You're basically stuck. It's a one-way street, and you're going to have a tax bite. And also, if your heirs inherit the REIT shares that you have, they will have a tax bite. They can't avoid it. That's different, very, very different than the DST, which gives you the step up that Leonard was talking to earlier.
Okay. Thanks.
Hey, Paul, if we have specific questions about our specific situation, do we talk to you or who do we contact?
Yeah, I would say a couple things. We enjoy talking with all of you guys about your specific situation, but I think it's sometimes more effective to have your accountant or CPA on the call with us because everybody's basis and tax situation is unique, and we technically can't give tax advice. I mean, we obviously look at a lot of tax returns, and we deal with thousands of clients, but I don't want to say that we can give you guys tax advice. We have CPAs that work for us, but they work, for our company, and I think those discussions would be more productive if you guys had an accountant that you were at least working to. So we don't want to be a substitute for your accountant, but we can certainly give you a lot of information about DSTs and 1031 in general.
Okay.
Oh, thank you, Paul. We'd like to thank the Sidway co-owners that were able to join today. We'll be sending out the recording to all of the Sidway co-owners. As always, should you have any questions, please don't hesitate to contact us. And thank you again for joining.
Thanks, everyone. Bye now.
All right, thanks. Bye.
Bye.